If your mortgage is renewing in 2026, there's a very real chance your monthly payment is about to jump. For a lot of Ontario homeowners, we are talking $400, $500, sometimes $600 or more every single month added to their mortgage payment. And you are not the only one, roughly half, and in some estimates, over 60% of Canadian mortgages are renewing in 2025 and 2026. Many at rates 15 to 20% higher than what people locked in during 2020 and 2021. So the question I'm hearing from GTA homeowner is simple, but heavy. Should I sell before this renewal hits me? Or should I hold on and try to ride it out? Before we go deep into that, I want to ask you for a quick favor. If this kind of honest, numbers-based content is valuable to you, please take 30 seconds to help grow Real Estate Wisdom with Vish. If you're on YouTube, hit like, click subscribe, and turn on the notification bell. That tells YouTube to show this to more GTA families who are also stressed about renewals and don't know who to trust. If you are listening on Spotify or Apple Podcast, tap follow or subscribe and leave a quick 5-star rating or a online review. Those ratings tell the platforms this show is worth recommending, so more people find it instead of just the loudest, flashiest voices. Every like, every subscribe, every rating and share help this community grow, so Real Estate Wisdom with Vish can keep cutting through the noise and delivering grounded GTA real estate advice. All right, let's get into it. Who should consider selling before renewal? Who shouldn't? And how to make the right call for you? Welcome back to Real Estate Wisdom with Vish. I'm Vishal Kapoor, your friend in real estate, a realtor here in the Greater Toronto area, host of this show, and the person people call when their mortgage renewal letter shows up and their stomach drops. On this podcast and channel, my goal is to break down real estate in a way that's honest, practical, and actually useful for regular GTA buyers, sellers, and investors. No hype, no sugarcoating, and no just buy now scripts. Today, we are talking about the 2026 mortgage renewal wave. This huge group of mortgages renewing into higher rates, and what that means for you as a current homeowner in the GTA. So what do people mean when they talk about the 2026 mortgage renewal wave? Between about 2020 and 2023, a lot of Canadians took out mortgages at very low interest rates. In many cases, rates that started with 1 or a 2. A big chunk of those loans were 3-year or 5-year terms. That means they come due in 2025 and 2026. Now fast forward to 2026, the rate environment is different. Most people renewing now are being quoted higher interest rates than what they had before. Bank of Canada and other analysts estimates that roughly 60% of outstanding mortgages will renew in this 2025-2026 window, with the typical payment increases in the 15 to 20% range if people simply renew as is. For a typical Ontario mortgage, somewhere in the $500,000 to $600,000 range, that can translate into around $400 to $600 more per month, and for some larger balances, even more. At the same time, markets like the GTA have shifted away from the wild bidding wars We are in a more balanced, sometimes buyer leaning environment, with more listings sitting on the market and buyers being choosier. So, here's the pressure cooker: higher mortgage payments, stretched household budgets, and a market where you can't just assume your home will sell in one weekend. 200,000 over asking? That's the context for the question we are dealing with today. Do I keep the house and absorb the renewal, or do I sell and reset my life and finances before the renewal bites too hard? All right, who should consider selling before renewal? Before I list any groups, I want to say this clearly. My job is not to push everyone to sell. For some people, staying is absolutely the right call. For others, selling before renewal is the smartest, most protective move they can make. Think of these profiles as green lights to seriously explore selling, not automatic instructions. Let's walk through three groups who should at least have selling on the table as an option. Profile number one, the payment shock family. The first group is what I call the payment shock family. You might recognize yourself here. You bought when rates were low, maybe pushed a bit to get into the neighborhood or school district you really wanted, and now your renewal code shows a big jump in your payment. If your renewal means a 15 to 20% increase in your payment, or in dollars, something like $400, $500, $600 more every month, and you don't have much cushion, that's serious pressure. Especially if you are picked up other debts over the last few years. You're already feeling squeezed by groceries, gas, and kids' cost, and you'll be leaning on credit card or lines of credit just to keep up. In that situation, selling before you start missing payments can actually be a strong proactive decision. It protects your credit, gives you control over your timelines, and usually leads to a better sale outcome than waiting until the bank is chasing you or your savings are gone. Profile number two, high equity, wrong house. The second group is the high equity but wrong house owner. Maybe you own your home for 8, 10, 12 years. You built a lot of equity, especially in parts of the GTA that grew strongly over the last decade. But your life has changed. The house that was perfect when the kids were little is now too big and too expensive. Or maybe your job has shifted. You are commuting less and your priorities are different. If your renewal is going to push your payment up and at the same time the house doesn't really match your life anymore, this is a great moment to ask, should we sell, lock in our gains, and move to something that fits our next chapter better? That means a smaller home in the same area, a condo closer to work, or a move to a slightly more affordable pocket where your quality of life is actually higher. In other words, the renewal is a trigger to design a better lifestyle, not just react to a bigger payment. The third group is the investor with growing negative cash flow. If you own a rental property where the rent does not cover the mortgage, the taxes, the condo fees, if there are any, and the repairs and your renewal is about to make that gap even worse, you need to be honest about what you are holding. Is this truly an investment that fits your long-term plan? Or is it a monthly drain that you are just hoping the market will fix? With higher interest rates and softer prices in some investors are discovering that what used to be mildly negative cash flow is now very negative cash flow. For those people, selling before renewal and repositioning that equity maybe into paying down their own home or into a different type of investment can be the smarter long-term move. Now, let's balance this out. There are also people who probably shouldn't rush to sell. Just because their rate is going up, for them, the right answer is often to adjust and adapt, not to hit the eject button on homeownership. The first group here is the homeowner with a manageable increase and solid income. Maybe your renewal increases your payment by $200 or $300 a month, noticeable but not crushing. If you have steady income, an emergency fund, and you are not already drowning in other debt, then you may not need to sell. In that case, your real opportunity is to shop your renewal properly. Talk to a mortgage broker. Compare offers from different lenders. Explore options like slightly extending your amortization to bring the payment down a bit while still keeping things sustainable. Selling a home you love in a location that works just to avoid a payment increase you can realistically handle usually doesn't make sense. The second probably stay group is the long-term forever homeowner. If you love your house, you love your neighborhood, your kids are settled in their schools, and you see yourself staying 10 years or more, then this renewal is just one chapter in a longer story. Yes, your payment might rise. Yes, you might have to adjust some spending for a couple of years. But if your income can support it and you are not at risk of missing payments, it often makes more sense to adapt and ride out this rate cycle rather than uproot your entire life over a temporary shock. The third group is the no clear plan B homeowner. If you sell, where do you go? Do you rent? Do you move out of the city? Do you buy something smaller? If you haven't thought those pieces through or you wouldn't be happy with the realistic options available to you, then selling in a hurry can actually create more stress, not less. The goal is not to simply get away from a renewal letter. The goal is to move towards a better overall situation. If you can't name a specific realistic next move you'd be happy with, you are usually better off pausing and doing more planning before you decide to sell. So, how do you actually decide in a calm, structured way and what you should do? Here's a simple 3-step framework I use with my clients in the GTA. Step number 1, know your true payment impact. Step 1, know your real numbers. Not a guess, not a headline, not what happened to your neighbor, your numbers. Pull out your latest mortgage statement. Look at your remaining balance, your current rate, and your term and date. Then talk to your lender or a mortgage broker and get an actual renewal quote. Ask for different scenarios fixed versus variable, different term lengths, and what happens if you extend amortization. When you see that new payment in actual dollars, you can honestly ask, can we carry this month after month without constant anxiety? If the answer is clearly no, selling or restructuring needs to be on the table. Step 2, zoom out from the mortgage and look at your life. Ask, what do the next 3 to 5 years realistically look like? Are you expecting career changes, maternity or paternity leave, kids starting daycare or university, family moving in or retirement? Are you planning to stay in the GTA or could a relocation be on the horizon? Then ask, does this house still match the life we are actually living or want to live over the next few years? If the answer is no, the home is too big, too far, too expensive, or just the wrong fit, and your payment is going up, that's a strong signal to explore other options. Step 3, compare 3 scenarios side by side on paper. Scenario 1, stay and renew. What's your payment? What's left over each month after all your bills? How does that feel? Scenario 2, sell and rent. What would a realistic rent be for the kind of home and area you'd be okay with? If you sold, how much debt could you clear? How much cash cushion could you build? Scenario 3, sell and buy different. Maybe a smaller place in the same neighborhood or a different GTA pocket. That's more affordable but still works for your lifestyle. Work with someone who can put real numbers next to each of those scenarios. When you see them in black and white, not just swirling around in your head at 2 a.m., the option that truly serves you best usually becomes much clearer. Let me share a quick example from right here in Ontario. A couple I spoke with recently had a renewal coming up this year. Their balance was around $550,000. A renewal quote they got would increase their payment by roughly $500 to $550 a month. On top of that, they had a car lease, kids and activities, and about $25,000 in credit card and line of credit debt built up over their last few years. On paper, they could make the new mortgage payment, but there would be almost nothing left. One surprise and they'd be in trouble. We sat down and ran the 3 scenarios. Stay and renew, sell and rent, sell and buy something smaller. When they saw the comparison, it becomes obvious that staying in their current house at the new payment would keep them stressed and stuck. In the end, they chose to sell and move into a slightly smaller home with a lower overall cost. The payment drop plus the chance to clear a chunk of their consumer debt gave them breathing room again. The key is this: selling wasn't good or bad. It was simply the move that best matched their numbers and their life. So if your mortgage is renewing in 2026, here's what I had love you to take away from this episode. Number 1, you are not alone. A huge number of Canadians are dealing with the same payment shock. Number 2, don't ignore your renewal letter but also don't make a fear-based decision. Get your numbers, map out your next few years, compare real scenarios on paper, and number 3, don't feel like you have to figure this out by yourself. If you are in the GTA and you want help walking through your options, whether that's staying, selling, downsizing, or renting for a while, reach out to me or reach out to your realtor or your financial planner or mortgage agent. You can send me a DM on Instagram or WhatsApp with the words Renewal 2026 and your property address, and I will help you run a personalized number-based comparison so you can make a confident choice. Again, if this episode helped you, please share it with a friend or family member who has a renewal coming up this year. Sometimes a calm explanation exactly what they need. Thanks for watching and listening to Real Estate Wisdom with Vish. I'm Vishal Kapoor. Provide value, integrity, service, and homeownership. See you in the next episode. Bye for now. Disclaimer: the information provided in this podcast is for informational purpose only and should not be considered as financial or investment advice. Consult with your professional before making any real estate decisions.